Have you ever wondered whether the world's most exciting company can also become its most dangerous investment? Because history teaches us something fascinating. Great companies and great investments are not always the same thing. In fact, some of the greatest businesses ever created have produced terrible returns for investors who paid too much. And today, there may be no better example of this debate than SpaceX. A company admired by millions, a company changing the future. A company building rockets, satellites, communications networks, and perhaps one day, cities on Mars. Yet despite all of those achievements, some investors are asking a very uncomfortable question. What if SpaceX is already priced for perfection? What if the future success everyone expects is already reflected in the valuation? And what would Benjamin Graham think about all of this? Benjamin Graham is often called the father of value investing, the mentor of Warren Buffett, the man who taught generations of investors how to separate excitement from reality. His philosophy was simple. A stock is not a lottery ticket. A stock is ownership in a business. And the value of that business ultimately depends on the cash it can generate over time, not headlines, not popularity, not social media, not hype. Cash flow. This sounds obvious, yet every generation forgets it. Every generation becomes convinced that this time is different. Every generation finds a new story, a new technology, a new revolution, a new reason to ignore traditional valuation principles. In the late 1990s, it was the internet. In 2021, it was speculative growth stocks. Today, it may be artificial intelligence. And increasingly, companies like SpaceX. The excitement is understandable. After all, what SpaceX has achieved is extraordinary. Before SpaceX, launching rockets was incredibly expensive. Within 2 decades, SpaceX transformed the economics of launch. Reusable rockets, lower costs, higher launch frequency, Starlink, Starship, NASA partnerships, astronaut missions, achievements that many experts once considered impossible. This is where investing becomes difficult, because investors often confuse admiration with analysis. The stock market does not reward admiration. It rewards accurate expectations. When investors buy a stock, they are not paying for what the company has already achieved. They are paying for what they believe the company will achieve in the future. And sometimes those expectations become enormous. Let's think about what investors are actually buying. They're buying tomorrow's dreams. Dreams of Starlink becoming a global communications giant. Dreams of Starship revolutionizing transportation. Dreams of Mars colonization. The challenge is obvious. How do you value a dream? How do you calculate the present value of a future that hasn't happened? This is where opinions diverge dramatically. History contains examples supporting both arguments. Amazon looked absurdly expensive for years. So did Tesla. So did Nvidia. Yet all three eventually justified enormous valuations. But history also contains countless examples of companies that failed to meet expectations. Investors remember Amazon. They forget hundreds of failed competitors. This creates survivorship bias. We remember the winners. We forget the losers. Now consider what Jason DeViccario highlighted in his interview. Supply and demand. Many investors focus exclusively on business fundamentals. Yet markets are also influenced by share availability. If only a small percentage of shares trade publicly, demand can overwhelm supply. Prices can rise dramatically, not necessarily because value has increased, because availability is limited. This creates a fascinating dynamic. Sometimes scarcity becomes confused with value, and SpaceX may soon face an interesting test. As lockup periods expire and more shares become available, supply could increase significantly. The business may remain extraordinary, but increased supply can influence pricing, especially when expectations are already extremely optimistic. This doesn't mean SpaceX will fail. Far from it. It simply means investing is more complicated than identifying great companies. The real challenge is determining what is already priced in, and that challenge becomes even greater when we enter the world of artificial intelligence. Because AI may be creating one of the largest waves of investor enthusiasm in decades. And that brings us to one of the most powerful ideas ever introduced to investors: the voting machine and the weighing machine. Benjamin Graham once said that, in the short run, the stock market is a voting machine, but in the long run, it is a weighing machine. Think about what a voting machine does. It measures popularity, emotion, excitement, momentum, attention. The voting machine asks a simple question. What do people like right now? Not what is valuable, not what is profitable, what is popular. Eventually, the market becomes a weighing machine. And weighing machines don't care about narratives. They measure substance, profitability, cash flow, economic value. This distinction helps explain why bubbles repeatedly occur. Consider 1929. Investors believed the future had arrived. Valuations expanded. Optimism became universal. Then reality intervened. The market crashed. Fortunes disappeared. The weighing machine returned. Now consider 2000. The internet was transforming the world. What they got wrong was valuation. The voting machine was in complete control. Then the weighing machine arrived. The technology survived. Many investments did not. This distinction is critical. A revolutionary technology does not guarantee revolutionary returns. This is why Warren Buffett repeatedly emphasizes valuation. What Buffett avoids is uncertainty combined with excessive valuation. He wants a margin of safety, a buffer, a cushion against being wrong. Because every investor is wrong sometimes. The goal isn't perfection. The goal is survival. Now let's connect this to today's market. Many analysts are increasingly focused on something called the Shiller P/E ratio. The ratio attempts to measure market valuation over longer periods of time, remove temporary fluctuations, reveal longer-term valuation trends. And today, that indicator is attracting attention. Because historically, extremely high readings have often been associated with lower future returns. If investors already expect perfection, perfection becomes difficult to exceed. This challenge isn't limited to SpaceX. It affects OpenAI, Anthropic, Nvidia. The higher expectations rise, the harder it becomes for reality to outperform them. Now let's imagine two different futures. In the first future, artificial intelligence transforms everything. The optimists are right, yet investors may still lose money. How? Valuation. In the second future, AI develops more slowly. Suddenly, expectations become too optimistic. Again, investors suffer. Notice something important. In both scenarios, valuation matters. Investing is not about predicting the future perfectly. It's about understanding expectations. History doesn't repeat perfectly, but it often rhymes. And investors who ignore history frequently rediscover old lessons the hard way. Understanding markets isn't only about valuation. It's also about identifying opportunity. And sometimes the greatest opportunities exist where almost nobody is looking. While the world focuses on AI and SpaceX, some fund managers are looking in completely different places. One of those places is Japan. For decades, Japan was ignored. The result created opportunities. This is why some of the world's most respected investors, including Warren Buffett, have increased their attention toward Japan. Go where value exists, not where attention exists. Neglected assets often become more attractive. Not because they're exciting, because they're overlooked. And this brings us back to SpaceX. The importance of quality. Companies where founders remain heavily involved often perform exceptionally well. Alignment. When founders own large portions of a company, their incentives often align with shareholders. Yet quality alone is not enough. Price still matters. A wonderful company is not always a wonderful investment. Exceptional businesses create exceptional returns on the capital they employ. This creates compounding. Small advantages become enormous over time. The best investors seek sustainable compounding, not quick gains. Wait for valuations to become attractive. Patience is the key. Will SpaceX justify its valuation? Will AI change the world? Nobody knows. The future has not been written yet. Investing is about probabilities. This may be the greatest lesson hidden inside the SpaceX story. Not that Elon Musk is always right, but that successful people develop frameworks for making decisions when outcomes remain unknown. Focus on principles. Focus on discipline. Your job as an investor is thinking clearly when others are not. Remember, In the short run, markets vote. But in the long run, markets weigh. Thank you for watching. Se ti è piaciuto questo documentario, iscriviti al canale e lascia un like. Fino alla prossima volta. Continua a imparare. Continua a pensare. Ci vediamo nel prossimo documentario.